Happy to be here. My name's Armani Ferrante, founder, CEO of Backpack, chief mad lad, I suppose. What got me into crypto? Ethereum white paper. It's kind of as simple as that. Yeah. Yeah. So what I was building before Backpack, a bunch of things. So got into crypto in 2017. Worked on anything and everything. Whether it was a brief stint at Alameda Research, was working on Ethereum L2s kind of in 2018. Worked on other L1s and then came into Solana in 2020 and had the opportunity to work on a lot of the early projects in the ecosystem. So worked on the first decentralized exchange, the first central limit order book on any blockchain ever. Uh, got to build one of the first wallets. Built the first developer framework for building smart contracts. Just a lot of stuff because
Yeah.
nothing existed at the time, and so
Yeah.
I've been doing a bunch of stuff since then. Yeah, so
Mm.
maybe to create a framework for the conversation.
Yeah, that would be great.
I think a lot of people like to have this discussion in the context of the decentralization spectrum, where
Yeah.
on one side of the spectrum you're centralized, and on the other side of the spectrum you are decentralized. Um, I think I kind of reject the framing
Mm.
because there's a bunch of nuances with
Yeah.
exchanges, in particular margin systems, that uh, uh, kind of make that framing kind of the wrong way to look at it.
Yeah.
Ultimately, whether you're building, a centralized exchange or a decentralized exchange, you should always view things through the lens of security and risk.
Yeah.
And so the way to evaluate an exchange, in my view, is through a couple kind of key categories. The first is through the lens of custody.
Yep.
The second is through the lens of margin risk management.
Yep.
And then the third, as we're kind of talking about in the in the backstage, is
Yeah.
through the lens of market integrity.
Mm.
And if you evaluate exchanges through this lens, you could kind of throw away the whole decentralized and centralized conversation and really focus on what matters,
Mm.
which is minimizing error and minimizing all the issues that you see in traditional finance.
Yeah.
And
Yeah.
each kind of point in the design space gives you different trade-offs with each one of these categories.
Mm.
So custody is generally what people like to think about.
Yeah.
You look at stuff like, not to throw Bybit under the rug, but they're the most famous example of like
You've
custody
raised this.
risk.
Yep.
The irony with Bybit was that it wasn't actually a centralized exchange problem. That was actually a hack of
Yeah.
the
Honeypot.
OSA safe.
Yeah.
That was the DeFi product that got hacked.
Yeah.
The DeFi front end, but I digress. But custody is a really nuanced question.
Mm.
Because it's not simply about having a custodian or being on chain.
Yeah.
The nuance of a margin system is that you actually don't custody your funds. There's no concept of self-custody in a margin system. So if you're trading perps, there's no like your keys, your coin. Like that's just not true. That's just a lie.
Yeah.
With a margin system, it's the protocol that controls your funds.
Mm.
So you have to have a thorough analysis of what are the security properties
Mm.
of the protocol.
Yeah.
And the nuance of a margin system is that there's a ton of ways to drain the system that are totally unrelated to the custodian.
Yeah.
You could have the best custodian on the planet that's totally secure. It never gets hacked. And you can still drain the margin system. So you have to look at the protocol through the lens of, a very comprehensive, holistic lens. The most trivial example of this is to just look at the risk engine.
Yeah.
And maybe the most notorious example of this is set your FTT collateral weight to 1, deposit in, FTT in size,
Yeah.
borrow USD and withdraw it, and then game over.
Yeah.
And that can happen on a centralized exchange. It can happen on a decentralized exchange. It can happen on a hybrid exchange. And so you actually have to look at the risk engine. You have to look at the code, and you have to look at how everything's parameterized to actually have confidence in the custody of an exchange.
Yeah.
Then there's, the second category of which I kind of alluded to, of risk.
Yeah.
Right. Where you see this kind of all the time. You saw it with like the Mango hack kind of early in the days of Solana. You saw it with like, recently with I guess the most notable examples like these pre-markets that get kind of manipulated, or I guess Jelly with Hyperliquids, like
Yes.
the most recent one. But it's happened with every exchange that's, that you can imagine, centralized or decentralized.
Yeah.
And so you have to have a really robust risk management team that can do all the financial modeling, that has all the right price banding, that's actually measuring risk in real time based on the collateral, the assets, the open interest, the positions, the borrows. And be able to manage this thing at all times. It's kind of like you're riding like a horse, or you're riding like a lion with reins, and you need to like make sure that you don't get thrown off.
Gosh, we quickly got into the weeds.
Yeah.
There's just like a lot of granularities. Yeah.
Yeah. So risk management's the second thing. And then the third thing is just market integrity and fairness.
Yeah.
This is something that TradFi is focused just decades on. There's tons of like rules, regulations, even legislation on market fairness. And I think this is a really interesting topic when you start talking about L2s versus L1s.
Yeah.
And the decentralized exchange landscape, where you have something like, a centralized sequencer, which might eliminate for example, vanilla custody.
Yeah.
However, that centralized sequencer has a position of privilege.
Yeah.
And depending on how you order the transactions, you can steal money by front running the user, causing people to get liquidated, omitting transactions.
Yep.
And so market integrity and fairness is a really important way to analyze these systems as well.
Yeah.
Where, a centralized L2 sequencer might get rid of the vanilla custody risk, but it doesn't get rid of this market integrity risk.
Yeah.
And so ultimately you have like a trust me bro analysis through that dimension.
Yeah.
And so there's tons of trade-offs to make.
Yes.
And this is why I kind of reject like the whole centralized versus decentralized framing.
Yeah.
And it's a very, very complex and nuanced conversation.
No.
As these systems are operational beasts.
Totally.
I think one of the reasons why I reject the whole sex-dex dichotomy is because my assertion is that the first principle, the way to build not only a centralized exchange, but any traditional financial institution is in the same way you build a DEX. And there's one property that you throw away that does not apply to the centralized exchange context. And it's simply censorship resistance. But everything else, trust minimization, verifiability, auditability, being able to compose with it, being able to build clients on top of it, whether it's builder codes or anything else, you can do all of that with a centralized exchange. The one ingredient that's different, you have a distributed validator set, you can distribute control, you can have all of the same trust minimized properties in a centralized exchange, but you have one difference. You have a compliance team that imposes censorship because that's the only way for you to follow whatever rules and regulations and laws that exist in all the various countries all around the world. And then the question is, okay, why do you do this? And what is like the relationship between the SEX and DEX when that happens? And the reason to do it, in my view, is simple. If you want to expand beyond crypto assets, right, you want to do something like, RWAs or equities is maybe the most salient example. Well, then you need to have this compliance function. You have to, this might not sound like sexy or cool or whatever, but it's just the truth. You have to KYC. You have to ensure there's no insider trading. You have to ensure there's no market manipulation. You need surveillance on the order book. And these are all the rules and requirements if you want to go from, 1 to 3 trillion of assets in crypto to, 100 trillion and beyond to give access to the larger kind of capital markets that exist in the world. And so this was really important for us to be able to build this function so that we could expand beyond crypto and to actually fulfill this dream that I think everybody loves to, work towards, which is the convergence of crypto and traditional finance so that crypto eats all of TradFi. And so, the reason why we did all this was so that we can get to that kind of stage where we can have crypto, we can have equities, we'd have spot margin, borrow, lend, perpetual futures, all cross-collateralized, cross-margin into a single account, built on a money market, getting yield on everything, right? To put in my Apple stock and withdraw dollars. And now you're starting to actually start talking about this dream that everybody's been talking about in crypto over the past 10 years of reinventing finance.
Yeah.
And a big important part of that is the compliance function for better or worse. And so I view them very harmonious. The wallet is just as important as the exchange for us. It's a single app. We want a single user experience. We want our users to be able to log in with their exchange account and be able to go, to the borrow, lend on Drift and get yield. But we also want regulated counterparties to do the same thing that digital asset treasuries did for crypto assets to now do it for market structure. You can think of regulated centralized exchanges as nothing more than a DAT for markets, for crypto markets, where you now have a regulated interface, an API for people that can't go and trade in DeFi directly. And there's a lot of these people. I would say the majority of the capital in the world falls into this category, where they need that interface where they can actually plug in and actually get access to crypto assets and crypto parties.
Mm,
Whether it's, fiat rails in every currency in every region around the world. If you want to talk to a bank, the first thing they're going to start asking you is, what does your compliance look like?
yeah.
You want to be able to deal with regulated counterparties, right? Pension funds, regulated hedge funds.
Mm,
They have LP agreements that have specific rules and requirements to be able to access, assets, right? This is why DATs even exist in the first place. Otherwise, I would just go create an account on Coinbase and buy my Bitcoin. Like, why wouldn't they do that?
yeah.
And so this filling this hole in the market and
Yeah.
playing this role
Yeah.
is ultimately why we went this route, because we think that there's not a lot of crypto native folks that want to bring the best that crypto has to offer and actually apply it to the context of traditional finance. And you
Mm,
need to do both.
mm, okay.
And so we hope to play that role and to help kind of the growing a DeFi ecosystem emerge, and to be able to route a lot of those resources and that capital inflows,
Mm,
and to bring it actually on chain,
got it.
whether it's in our own kind of exchange itself or into Solana, Ethereum, or beyond.
Got it. So if I understand correctly, what you guys are building is actually this hybrid model. So in a way, you have centralized exchange, very regulated, very compliant, and you talk about having strong compliance function to make sure it can't be evil, right? And don't be evil, and then such that you are able to onboard a lot more users that don't want to interact on chain, and that flows can come in, but you also have the DeFi access through the wallet, such that you kind of have the best of both worlds. That's kind
The
of
one thing I would add
yeah.
is to, don't be evil or can't be evil.
Mm.
It has to be built into the system
Yeah,
from an engineering point of view. You have
yeah,
to be able to use it, you have to be able to trust it with like code and math.
yeah.
And so not only do we have this, compliance function that all
Mm.
TradFi firms have, but we also built the entire exchange as a permissioned blockchain. It's a multi-node validator network. There's no single point of control.
Oh, for the centralized
The
exchange. Oh, I
centralized
didn't know
exchange
that.
is
Okay, that's
built
interesting.
in as trust minimized a way as
Yeah,
any of the modern dexes.
I see.
And it makes sense for our context, because if you want to be able to solve these problems,
Oh,
whether it's
right.
FTX,
Yeah,
2008 financial crisis, the 1930s, or
yeah.
anything in between, you have to do it at the engineering level
Mm.
and not just rely on humans to.
Yeah.
I'm also a FTX victim. I lost $14.5 million on FTX, so I can
The
relate to you.
victim panel.
Look, I mean, I think it's a super nuanced question.
Mm.
You can't give like one answer for a size fit all. There's certainly people that are more afraid of themselves than they are
Yeah.
afraid of the exchange. I would argue there's not a single margin system on the planet Earth, whether
Mm.
it's a centralized or decentralized exchange, that doesn't ultimately have a multi-sig. If you look at 99.99999% of all decentralized exchanges, other than maybe like Orca on Solana and Uniswap on Ethereum mainnet, they all are controlled by multi-sigs, which means
Of
they're
course.
all centralized exchanges at the end of the day. From
Mm.
a security point
Yeah.
of view,
Yeah.
you could have 3, 4 people steal all the money like that. And so to answer your question, I don't think it's there's not like a singular answer, and it's a
Mm.
super nuanced conversation.
Yeah, agree.
And
Depends on
so
the
yeah.
user's knowledge as well, right? How comfortable you are, how good you are. Because some people might be like, I don't want to operate my own wallets. I might lose it, right? There's nobody I can call. Yeah, totally.